Every news agency is talking about how our job market is out of whack right now, but they're all missing one key point, and I'll explain what's going on in our job market in less than 2 minutes that we understand what's really going on. Our economy is about $25 trillion big. That means it takes 1 year, 365 days of our entire country, the United States, to go to work to produce about $25 trillion worth of stuff, goods and services. And in the years 2020 and into 2021 and a little bit into 2022, the United States government infused our economy with $5 trillion worth of fresh money. That's about 20% of our entire economy. They essentially injected our economy with 20% more money. And do you know where that money went? Well, I'll tell you. $1.8 trillion out of the $5 trillion went to households, whether it's in the form of unemployment, stimulus checks, or other free money for people. $1.7 trillion went to businesses, whether it was in the form of PPP loans or grants, free money for businesses. $500 billion went to the healthcare sector. $750 billion went to local governments to continue spending money, and the rest of that money went into just miscellaneous places. So the government created about 20% of our economy in a click of a button, and they injected it into our economy. Now, let me tell you why that's so significant. It's significant because our economy is trying to grow by itself. And do you know what a good growth rate is in our economy? 3%, even 2%. When our GDP, our economy grows by 2%, that's considered a good growth rate. Well, the government essentially grew the amount of money in our system by $5 trillion in the click of a button and injected it into our economy. Now, what's that going to do? Well, when businesses get trillions of dollars, they're going to want to take this money and grow it and create more jobs. This is one of the things that I've been talking about as to why I'm doing this investor summit tonight, talking about how our economy has changed, talking about how money has changed. I hope to see you there. It's at 8 p.m. Eastern time tonight, which is why if you haven't registered yet, I got the link for you down in the description below. It's a free investor summit where I'm going over, one, how the economy has changed and how you can capitalize on investments in today's economy. But now, if the government can create 20% of this money, $25 trillion is what our economy creates over the course of a year. The government created $5 trillion like that. What's that going to do? It's going to create more jobs. If people have more money to spend, whether it's because businesses created more jobs or because people got free money from the government or because the government gave money to healthcare, not just in the form of checks to healthcare workers, but to innovate, to spend money into healthcare businesses, that's more people who have jobs. And when the government gives money to local governments, that means governments have more money to build roads and bridges and other things. That creates more jobs. That means people have money because the government paid this money out. And what is that going to do? Well, that's going to create growth. Because if you're a business, then you got $100,000, $1 million, $5 million, that means you have the ability to go out and create. But if people lose that ability to spend, or if you cannot continue growing, that's when you start to see that switch. So when people talk about the job market being so hot, that people struggle to find jobs, or that companies cannot find labor, well, it's not that our population has shrunk. In fact, our population has grown over the last few years. Yes, we are seeing some people retire, but we're also seeing more young people start to enter the workforce. What's happening is that we have created so many jobs because there was so much money entering our economic system, and now we're seeing the impacts of that. And this is why the Federal Reserve Bank keeps saying that the job market is too tight, and they want to loosen the job market, meaning soften the job market, meaning they want to create more unemployment. And the reason what they want to do that is because when everybody has the ability to get a job, and this is going to sound very painful, this is not me telling you this, I'm telling you what the Federal Reserve Bank says, but just understand what's going on. When everybody has a job, or when it's very easy for people to go out and get another job, that's going to push wages higher. Because now you can say, oh, you're only going to pay me 45 grand? Well, they're paying me $55,000 down the street. I'm going to go over there. Oh, you're only going to pay me 55, they're going to pay me $70,000. Oh, this is all you're going to give me? I'm going to go over there. When you have all that negotiating power, wages go up, which is good for consumers. But what the Federal Reserve Bank is saying is, yeah, generally that's good. But when you have a time when you have such high inflation and wages keep going up, that also means spending ability goes up. Because now when you make $70,000 instead of $45,000, what does that mean? It means you make more money, which means you have more money to spend. And in a spending-based economy, the more money you have to spend, the more demand that there is in our economy. And the more demand that there is in our economy, the higher the prices of things go. Don't believe me? Take a look at the prices of homes. When you have low mortgage rates, what happens? Everybody wants to buy a home. When mortgage rates were at 3%, you had a huge influx of buyers who wanted to take advantage of the low mortgage rates. What does that do? More buyers means more bidding wars, which means higher prices of homes, higher home prices. What is the Federal Reserve Bank trying to do? They're raising interest rates to cool down demand. It's not just in the housing market, it's in the entire economy. And that's why one of the reasons the Federal Reserve Bank says that they want to soften the labor market is because everybody has a job. And the Federal Reserve Bank says that they still predict, even though the Federal Reserve Bank has come out and said publicly, they no longer believe that a recession is coming, they still believe that the job market is too tight and they want to loosen the job market. But the reason why the job market is what it is today is because of what the Federal Reserve Bank did in 2020 and 2021 and even into 2022. The Federal Reserve Bank was the entity that was fueling all the spending. The Federal Reserve Bank was the entity that was printing all the money that was going into the economic system. And now what they're saying is, maybe we printed too much money, which is kind of ironic because in 2020, the Federal Reserve Bank was saying, there's no way we're going to have inflation. In 2021, they said, oh, okay, we'll have a little bit of inflation, but it's transitory. In 2022, the Federal Reserve Bank is saying, okay, we have an inflation problem. And in 2023, the Federal Reserve Bank is going to say, it's taken more work than we expected to bring this inflation down, but hopefully we won't see a recession. But there's an impact to the higher interest rates. There's an impact to having all this money printing. And now the Federal Reserve Bank is trying to pull this money out. And this is why. Again, it is so important for you to understand how this economic system works because the reality is our economic system runs on spending. And when people make more money, not only do they have more ability to spend, the second part is they have more ability to borrow. Because we don't just live in a spending-based economy, we have a credit-based economy, which means you have the ability to spend more money thanks to credit cards, lines of credit, and debt. In fact, Wells Fargo, I put a video on this just a few days ago. Wells Fargo put out a piece. And now many other companies have been saying something similar ever since Wells Fargo research report came out. Wells Fargo says that all this home equity that people have is a great sign for the economy because this means you should or can go out, pull cash out of your home, and spend money. So if you are struggling financially, like many Americans are, don't worry about going into credit card debt. Just pull out this equity out of your home. You can pay 7% now on a home refinance as opposed to 20% on your credit card. And now you can continue funding your lifestyle. This is what we've been seeing a lot of articles now over the last week published, especially after this Wells Fargo report. But this is where understanding how did we get here? We got here because of the money printing. Where are we going? The Federal Reserve Bank is trying to pull the money out. They're trying to increase the amount of job losses, not job losses, but unemployment. But again, this is where that financial education is so important. And a lot of people have thoughts on what's going to happen in our economy. And my goal for you is not to blindly follow a random guy on YouTube. My goal for you is not to be worried or panic or anything, but rather be prepared for anything because nobody can predict what's going to happen tomorrow or next year. Nobody can predict if and when we're going to have a recession. I mean, we know we will have a recession at some point. A recession has happened in our economy pretty much every decade for the last century, so we know a recession will come. We don't know when. But what your job is to be prepared. Because at the end of the day, the people that build real wealth are the people that are financially educated and that are prepared to capitalize on opportunities. Now, this doesn't mean you shouldn't be investing your money now. This doesn't mean that you shouldn't save your money ever. This means get financially smart and understand that we have real risks in our economy. Now, it can take time for these real risks to spread because, well, there's still a lot of money out there. And yeah, people are struggling spending more money. But when I say more money, I mean people are now finding more ability to spend because they're pulling cash out of their homes. People are pulling money out of their 401k. Those are red flags. But our system runs on spending. So as long as people can find money to spend, it doesn't matter where it's coming from. It doesn't matter if it's your credit card. It doesn't matter if it's your 401k. It doesn't matter if it's the equity in your home. If people have money to spend, the economy is going to continue growing. And that's where you got to also remember that there's also a tipping point when people get tapped out and no longer have the ability to spend. And this is where the Federal Reserve Bank is working to raise interest rates to stop the demand or lower the demand. Because if you lower the demand, you lower the amount of people that are spending, which lowers the price growth of things. So understand now, this is why I say 2023 is not the year for you to finance a new truck. 2023 is the year for you to get financially smart because yes, we have red flags. Yes, it's going to take time for everything to play out. Yeah, we have a lot of debt in the system. Yeah, we've seen interest rates rise. Yeah, we still have high inflation. Yeah, people are starting to struggle with spending. And yeah, student loan payments are restarting in October. But people are still spending. And this is where you got to be smart, be financially educated, work to get prepared, and use this time as a time to build your savings, build your wealth, and also build your financial education. And this is what I'm going to be talking about in my Investor Summit tonight. So I hope to see you there.